Hello and welcome to this Independence Day market special. As we celebrate another Independence Day tomorrow, I can safely say that one big reason for the optimistic mood all around is also how well stock markets have done. After all, a booming stock market means optimistic corporates willing to raise money, invest, hire. It is very simply a virtuous cycle. In the last 4 months, markets have taken off, and how? Literally, and I mean, if you can use this, wordplay, snatching its independence from any barriers or resistances whatsoever. Things have been going very, very well. On this show, we take stock of what markets have done, assess things, and also talk about what next from here. I am Prashant, and with me, my colleague, Surabhi Upadhyay. Surabhi, hi.
Hi, Prashant. Absolutely. It has been quite a fantastic year. The last 1 year has been, fairly positive for the equity markets. Benchmark indices, they've actually rallied about 10% in the last 12 months or so. This is from the last Independence Day to now. Of course, today we had a bit of a volatile Monday, but the market did recover from the lows of the session. We ended pretty much around the flat line. But Prashant, I think the commentary, the conversations have become very, very optimistic about more money finding a home out of China coming into India, the long-term growth story, the trajectory, sectors like defense. I mean, maybe Monday, Tuesday, the day-to-day, of course, might be volatile, but I think the medium-term commentary remains fairly optimistic.
It remains very optimistic, and some are saying, well, maybe too optimistic, right? As someone joked that, on the small cap index, someone said, well, we should not have weekends because then the 0.5% daily compounding is interrupted, right? I mean, of course, I'm just joking to make a point, but, well, markets have done so well, especially since the end of March. So, well, let's bring in our experts. Devina Mehra is founder, chairperson, and managing director, First Global. We have Trideep Bhattacharya, chief investment officer of equities at Edelweiss AMC, joining in as well. Great to have both of you here on this special program. Thank you very much on joining us on what arguably is pretty short notice. Thank you. Devina, if I can start by asking you, I mean, as we take stock and as we look ahead, what's your sense? I mean, you're someone who looks at things from, both macro, 30,000 feet, and also bottom up from a micro kind of perspective. How are we looking in the medium to long term?
Yeah, first, let me wish you and your viewers a very happy Independence Day in advance. And you spoke of the 4 months rally from the end of March. Actually, I had tweeted, I mean, it's on record on March 28th, that the risk now is in not being invested rather than being invested, because you are much more likely to miss out on an up move, and the likelihood of a crash is minimal. In fact, I had even said that I don't know whether this is the exact bottom, but it is definitely in the range of the bottom. And the index was sub 17,000, then 16,900 something. So it has shown that rally. But even today, I would say the risk of a crash is far lower. And therefore, you should remain invested, because the fact of the matter is that in markets, it is much more likely that if you sit it out, you will miss out on an up move. On a 40-year basis since the Sensex started, if you missed out on just the 10 best up move days, your returns go down by 2/3. If you miss out on 30 good days, which is less than the average of a day a year, you miss out on 90% of the returns. It's as drastic as that. And right now, we are still not above the trend line, much above the trend line, which is when the risk of a crash happens. So whether you look at PE terms, we are not, at a very high PE. Whether you look at the history, you had this whole period from 2010 to 20, when India underperformed relative to the globe, underperformed relative to its own history. So instead of this 15-16% compounding we have in mind, the equity markets in that decade compounded only about 8.5%, which was just barely over the fixed deposit rates for that era. So, I mean, we are still don't have the danger of a big crash. If you look at fundamentals also, I would think that, they said P's are not very high, and earnings or growth also, I reckon would be not bad at all, given that for one, crude, while up from its lows, is still quite a bit down from its high. And crude is a big thing for India, both for the economy, because it drives a lot of things from bringing down inflation to current account deficit, to driving growth. And crude means not just crude, it means all the downstream products which are inputs for a whole range of industries from textile, chemicals, FMCG, etc. So fundamentally also those things are not looking bad. I mean, the economy is, if we look at it broadly from a medium to long term, there are concerns, but not so much on the corporate and stock market side.
Devina, I've said this before. I remember that tweet, by the way. So it was bang on. And I'm sure that you will, like the 20th of March tweet, you will tweet 2 or 3 days before the market turns on the downside as well.
I hope so.
That'll complete the loop, really. But only half joking. Surabhi, sorry.
No, absolutely. That becomes another indicator. I'm going to look out for, make sure my alert on Devina's tweets is active on my mobile phone. But thanks very much, Devina. Great to have you on the show. Good to have you on the show, Trideep. I was just thinking as we were warming up for this session, I was just thinking this Independence Day actually is quite special from a market standpoint because, we have independence from a lot of leverage. We have independence from bad bank balance sheets. We have independence from, NPAs. We have independence from the crunching blow of COVID. I mean, that was a tough phase, right? So from that standpoint, that's a real good, feel-good factor to have as we're looking at the 15th of August today. So Trideep, you tell us, that's the optimism, but you have to be a realist as well. And, inflation is there on the horizon. Let's not forget that. All things put together, next 1 year, now I'm going to ask you for this. Is the market heading higher? Can the Nifty do another 10%? Or do you think consolidation is probably something we have to be ready for?
So I mean, I'll wait away from making an immediate market projection, but I'll put some things in context which will tell you what I'm looking forward to. Look, I mean, I was just before, as I prepped this interview, I was just looking at October 21 highs, and from there where market is today, or it's about 7% higher from where it was the last high, and that was in 2021. And if I were to sort of look at the earnings and what they have done over the last 2 years, the earnings have been up by about 35% since then. So net balance, the valuations today are actually more reasonable than last time we hit all-time high and there or thereabouts. And in that context, I would argue that the pockets of earnings resilience are just about playing out, which are, as you said, financials, capex, and whatnot. So, I would say the true nature of the earnings are yet to get reflected with regards to in the markets. So, if you were to look at 12 months from now, where we would probably be clear of the macro event, which is the national elections, middle of next year. And assuming all that fine, we should be kind of reasonably higher from where we are. So I would bet on a higher than lower percentage. I would leave that to more people who are a little more succinct about that. And that stems from the confidence from the pockets of earnings resilience that I broadly covered. And I think that will play out even more vigor once we sort of see in the next calendar year and a half or so.
No, absolutely, I get that. Devina, you look at what global markets, etc., are doing, right? Because I mean, one can't be independent of what everything else is. It's incredible, right? I mean, we start over the last 2 years. We were talking about first rate cuts, then we were talking about rate hikes, and everybody's waiting for a recession. 500 basis points of rate hikes in the US, and the ugliest inflation surprise in the last 50 years, and the economy is just doing just fine. I mean, there is no hard landing, soft landing, maybe no landing. How do you use that as an input, and how do you think about that, Devina, in terms of investment implications as well?
I would call it a soft landing. So, I mean, they've managed to, whether by design or otherwise, they've managed to navigate this with a soft landing. And of course, the markets didn't have a soft landing in that sense. Markets in 2022, you'd be surprised, it was the worst year in global asset markets, even on a 100-year basis. So it was as bad as that. And the first 9 months were even worse. So you had a market globally where every single asset class was down, every regional equity index was down, every single bond index was down, other than oil and gas and a couple of agri commodities. Nothing was up for last year. So I was very clear that when 2023 started, that markets would be up because, that kind of year doesn't repeat. The bond markets were the worst in 200 years since records began. So, but I mean, if you're talking about the economy, specifically the US economy, last year, I think October or so, there was a yield curve inversion, which is that 3-month rates went about 10-year rates, which in the past 50 years has never failed as an indicator for an impending recession. But that didn't happen. So, which also tells you that in macroeconomics, because the data points are so few, in very few macroeconomic events would you have 30 data points where only one variable changes. That that's why the predictions on macro can go all over the place. So that, I mean, it's a good thing that that indicator failed and they didn't have a recession. Our view on global asset markets remain positive, and particularly on equities remain positive. And also on top of that, we think India will be still remain in an outperforming bucket, because as I said, there were like 10 odd years when it was an underperformer consistently. So that has changed. So for now, that appears likely to continue. So broadly, that's the picture. I was never of the view, if you go back to all my past interviews, that you will see a Fed rate cut in 2023, because it was very clear that inflation cannot come down in that short a time frame to anywhere close to 2%. So now the market has also come around to that yes, there will be no rate cut this year. So you just, if look at long enough data, you get enough indicators on that. But as I said, the positive surprise was that there was no recession in the US.
And yeah, incredible, right? Thanks for that, Devina. Stay with us. We have to take a quick commercial break, but both Devina and Trideep are with us. We come back for a more sector-specific conversation. Where do you look to invest now to make money from here on? Stay with us.
Welcome back. You are with us on our special show, India at 76, the market edition. Well, he's not here today, but we miss him dearly. And he has been the big bull, one of the biggest voices on the idea of India and investing in that idea. I'm talking about veteran investor Rakesh Jhunjhunwala. It is his first death anniversary today. And Big Bull, as the world knows him, was, of course, a big proponent of the country, the economy, and the potential that it has ahead. Well, Nimesh is joining in because he has put the spotlight on all the top holdings of Rakesh Jhunjhunwala and the kind of alpha, the kind of wealth that these stocks have created for his portfolio. Nimesh, take it away.
August 14 marks the first death anniversary of ace investor Rakesh Jhunjhunwala. Fondly remembered as the Big Bull, Jhunjhunwala had deep conviction that this is India's era and that the mother of all bull runs was ahead of the domestic stocks. All his wisdom has turned out so true. So let's look at the key holdings of Rakesh Jhunjhunwala on the first death anniversary. If you look at his total investments in the listed space, that is worth close to 37,500 crores as of yesterday's closing. That's only the listed stocks which I'm talking about. In fact, in the last year, 1 year since his death, there hasn't been much churn in his portfolio except for the 5% stake sale in Rallis India that they sold to the Tata Chemicals for a deal worth close to 200 crore rupees. So that was a big stake sale there. Apart from that, let's look at the top holdings of Rakesh. The top holding is Aptech, where he owns close to 45% stake. Star Health, he owns close to 17%. NCC owns close to 13% stake. Nazara Tech 10%, and Metro Brands he owns close to 10%. There are some other holdings as well, which includes the names like Geojit Financials 8.2% stake, Viatech Vabag he owns close to 8%, Agrotech Foods he still owns close to 8% stake, and of course you spoke about Rallis where they sold 5% stake. But the two big holdings of his where he's made a lot of wealth, that is CRISIL, he still owns 5.5%, and Titan he still owns 5.4%. All the holdings that I've seen or I've mentioned are above 5% stake. But as Rakesh was Rakesh, his Midas touch continues in many of his holdings as well. So look at the stocks which have done really well in this last 1 year. All the stocks have rallied between 25 to 140% in this 1 year itself. So which has been the big performing stock? The big performing stock in his portfolio has been NCC. That stock is up 140% in the last 1 year. Viatech Vabag close to 108%, and Aptech has also rallied close to 90% in the last 1 year. But his big faith was on Tata Group stocks, and even those have done really well and rewarded him handsomely in the last 1 year. The big stock in that group, in the Tata group, was Tata Communications. That stock has appreciated more than 50% in the last 1 year. Indian Oil is another stock which has appreciated close to 42%. And Tata Motors, that's been a big outperformer for him, not only in the last 1 year, but in the last many years as well. Last year, it is up 28%. But if you look at Rakesh's holding, he was the first to turn bullish on Tata Motors a few years back, and since then the stock has appreciated more than 6 times for Rakesh Jhunjhunwala. But there are some stocks as well which have given negative returns in the last 1 year. Of course, we spoke about rallies where he sold a 5% stake, but apart from that, Star Health and Jubilant Ingreva, these are the two names where the stocks have down almost 10% in the last 10 years. But broadly, if you look at his wisdom or the Midas touch, that continues with his portfolio as well. So yes, it's been 1 year since he's not with us, but his legacy will continue for many, many years to come.
Oh, absolutely, Nimesh. You said it. Thanks very much. Very interesting to go back and look at Rakesh's holdings. Indeed, the stock market and the country will always remember him as the ace investor. Devina, now that was Rakesh's portfolio. I mean, it was just, the timing is such. 14th, he left us. 15th, we're celebrating Independence Day. So we thought it's a good time to kind of, remind everybody. But you tell us, I mean, from here on, since you are positive on the market and you think India will outperform some of the global markets as well, where should people put their money? Defense, but it's already run up so much. CapEx, should it go back to technology, which is underperforming right now? Where to invest?
So I'll tell you, as far as our portfolio management scheme is concerned, the PMS is concerned, where we are overweight. So the sector where we are most overweight continues to be capital goods and industrial machinery, which I've spoken about in the past, because that's been our most overweight sector for almost 2 years now, since October 2021. Which is when we thought that its 12-year status as a dog sector was changing. And every quarter we look at it again, that is the run over. Until now, our systems have not told us that the run is over. I mean, we've cut back, we have booked some profits because stocks went up 2, 3, 4 times and so on. But that still remains a very overweight sector for us. This calendar year, where we have added weight has been auto components, pharma, a couple of construction stocks. If I look at the latest rebalance, the change I see is that I see a few more FMCG stocks. I mean, ITC and Britannia, of course, have been big winners for us. But other FMCG stocks now, our bottom-up systems are picking up. They're still not like a thumping by the sector, but it's certainly beginning to look better than it did. IT, you mentioned, IT, we would be slightly overweight or just about market weight to slightly overweight. So, not something, again, as a thumping buy, but definitely I don't have a very negative view on it either. Again, a sector where we've changed some stocks, but we still remain slightly above market weight.
Devina, IT and pharma and FMCG, is that a bit of a defensive stance? Or is that you think these spaces will make a lot of money in absolute terms from here?
Pharma is something, as I said, since January we've been adding. So it's not like a very recent thing. FMCG, as I said, is not yet a thumping buy. But definitely our systems, which barely liked any FMCG stocks in the past, have now rating them somewhat higher. So, if you remember, 2020 was the boom time in FMCG. I did a whole half-an-hour program on your channel on why you should not look at FMCG as all-weather or will always do well, those kind of stocks, because there are long periods in history when those stocks have not done well, and which period you saw since then. So that may be coming to an end. That's what the signals seem to be showing.
Okay, got that. Trideep, same question to you. What is the house call now? What are the biggest overweight sectors for you? And, what are the themes you'd perhaps stay away from and why?
Our historical overweights have been lending financials, we've talked about earlier as well, and capital goods. But I would say that within this, the complexion is changing. I would say that within financials, or lending financials, the focus incrementally more on NBFCs than banks, but historically it has been more banks than NBFCs. I would say that within capital goods, while historically it's been more equipment manufacturers, now it's going towards more contract EPC players. So a bit of change of stance within the sector or subsector rotation, if I will call it. But incrementally speaking, I would point to probably real estate, pharma, and select consumer discretionary, where we have added a bit of more capital over the last 3 to 6 months. Select consumer discretionary, keeping in mind that we have World Cup coming up and a few other events lined up where some of the companies might actually stand to benefit from that. Real estate, in my opinion, is in the middle of a 5 to 7 year upcycle, so we've been structurally bullish. But incrementally, as we have seen correction in some of those stocks, the indirect plays on real estate, that's where we have added on. And pharma, I think, was something over the last 3-6 months, we've got incrementally bullish on the US scenario, US pricing scenario. So there we've added a few players in our portfolio to that effect. So those would be broadly the areas that we incrementally looked at, and a change in historical stance.
Okay, got that. Well, thank you very much, lady and gentlemen. It's been a pleasure speaking with both of you. Gives us some ideas to kind of work with, and also some triggers that we have to keep in mind as we look at entering the 77th year of India's independence. Thank you very much to all of you for watching. That's it from Prashant, me, and the entire team that has put this show together. Once again, wishing all our viewers a very, very happy Independence Day.